pick up where we left off last time, talking about credit derivatives, and also I promised you that we would go through that trade, the extinguisher swap. And although it is just one transaction, it is to me sometimes quite surprising how much you can learn simply by understanding very well, understanding completely, one transaction. And so the file today I'm going to use is the same file from last time. Now, I think if you remember, I talked to you about the concept of wrong way risk, right way risk and wrong way risk. I think it might have been this one. So we talked about total return swaps and how that works, and it has some similarities to the equity swap that was discussed extensively in the capital markets class. But this time, instead of using the return of a stock, we use the return of a bond instead. You'd find that in finance, it is actually, a lot of things are based on very similar principles, and the principle is simply that, I know I have made this point before, but I want to make it again. So if you are an investor, you can always go out to Bank A, you borrow some money, and you pay LIBOR plus something, so you will never get away with LIBOR flat. And with that money, you go and buy something, X, whatever X might be, from Bank B. Now, you think about this, and if Bank A and Bank B, if they happen to be the same entity, so you don't have Bank A and Bank B, you have Bank A and Bank A, then what you end up with is Bank A faces the investor, so the investor is still paying LIBOR, and the investor is now getting the performance of X. I say the performance because although you are getting X, yes you are, but don't forget that in the end, at the very end, at maturity, you do have to pay back the par value because you borrow the money. So this is just the beginning. So you get the performance of X. In fact, that would be the more complete way to draw this. So you get the performance during the lifetime, and the performance is all you care. And then at the end, you pay back par. And then taking this concept one step further, you can now turn it into a derivative. Turn into a derivative. In this instance, it is a prime example of a structured swap. A structured swap is still just a swap, which is you exchange something for something. Now, if you can follow me here, this is something that happens 1,000 times a day. And you saw that last term when that performance of X was the performance of Country Garden stock price. The total return swap is no different. It's just instead of the stock price performance, you will now get the performance of a bond of some kind, total return. So that will be coupons plus any kind of capital appreciation or depreciation. Are you with me there? Yeah? So it is important that you get to understand even just a basic principle behind a total return swap, because it makes it a lot easier for you to understand how these things are put together. Okay. Everyone is okay with that? Okay, so that's the total return swap last time. And we also went through the concept of the wrong way risk. And just to remind you, so if the wrong way risk is an idea that is related to trading in derivatives, where just depending on what you are actually trading, you ask yourself a simple question. A derivative trade would have wrong way risk if, just as your counterparty's credit is weakening, the trade is also likely to be going in the wrong direction. In other words, your client will be losing money on the derivative trade just as their financial strength is worsening. And somebody made a very sharp comment last time about Country Garden. Yes, that was totally a good example of the wrong way risk. And I made the example last time that if you were trading oil with an airline, so normally, oil price goes up when economies are better, although that one is arguable. But oil price typically will go down when economies are suffering. And if you are trading with an airline and the airline is long oil, so here they are long oil. In this one here, they are short oil. Oh no, I beg your pardon. Here they are short oil. They are selling oil. Here they are long oil. So on the right hand side, if you are long oil, and if the oil price goes down, then this trade will go bad for Singapore Airlines, and that is also a moment when it is likely that the economy is bad and this company is not doing so well. Now, that is known as the wrong way risk. Is everyone okay with that idea? I'm going to talk about the extinguisher swap, and you will see this idea sort of floating around or hiding in the background. Even if it's not immediately obvious, the central theme of wrong way risk is what is the correlation between general economic conditions as it goes up and down, and also the likely mark-to-market of a particular trade. I mean, that is the heart of the matter. When economies go up and down, what is likely to happen to the mark-to-market of this trade, either from a bank's point of view or a client's point of view, which is just the direct opposite. Now, with that in mind, let me explain to you what is that trade, the extinguisher swap, which is one of the best trades that I think we have given to you. One of the best trades actually in that PowerPoint presentation. Okay, now, first of all, there is a class of product. These are sometimes called contingent credit. And contingent credit just means there is a derivative transaction of some kind, and it contains credit risk, and the payoff of that derivative transaction can sometimes change depending on what is happening to certain credit underlyings. And this is an example of that. Now, where is the trade? Here. Let me say two things about this trade. The first thing is you learn a lot from understanding this trade, which I will go through with you. That's the first thing. The second thing is you might have noticed from Ryan's CV that he is head of, I think it's called Cross Asset Solutions in SocGen. Did he introduce himself like this? Yeah, cross asset structuring. Now, this term actually has some meaning, and after I explain to you this extinguisher swap, you will understand a little more about what Ryan does, because it is an example of cross asset structuring. Okay. Now, let me go to this trade. And first of all, there is a special purpose vehicle sitting in the middle, which kind of complicates things a bit. But you can just as well have, instead of the SPV, if this was the client, if this was the investor, that is also possible. So think of the SPV and the client as being, one of, two of the same thing. It's just a different legal entity. And what has happened is that, first of all, the client buys a bond. Now, in this case, this bond is actually, it was issued by Telstra. Do you know who Telstra is? Telstra is, I guess, the Australian equivalent of China Telecom. Thank you. Yeah, China Telecom. It is the biggest telecom company in Australia. So very, very hard to imagine a company like that ever going bankrupt. I'm not saying it's zero, okay? It's not risk-free. Even governments are not, but the risk is very small. It's just like you can't imagine China Telecom going bankrupt or China Life or whatever, okay? Too big to fail. So that is the kind of side remark I want to make to start with. So client purchases a bond issued by Telstra. Now, it's an Australian company, but not only that, the bond is in Australian dollars. I guess we spoke, now just to make a side comment again, these companies, especially Australian companies, quite often they go to the euro market. We spoke about this, right? So they go to euro market and they would issue a bond in dollars. And we even discussed why they would do that. Why would they do that? They're not doing that here, okay? But sometimes they do. Like Qantas Airlines or even Telstra, I bet you my left arm, they have issued a euro bond in the euro bond market in dollars. I hope they have, otherwise I'm going to use my left arm. Why would an Australian company issue bonds in US dollars? Do you remember we discussed that in capital markets? Yeah, why? Because that's where all the money is, right? It's a much bigger bond market. You know, the euro. It's called a euro dollar. It's so confusing. The euro dollar bond market. Now that's not what they're doing here, and you can see why then the demand is likely to be a lot smaller, because there are investors out there. There are thousands of investors. They like this company. They know this company. They are comfortable with the credit, but they are not Australian dollar investors. They are US dollar investors or yen investors, whatever. So let's say you are American. You are a dollar investor. I really like this company. I like their credit risk, but I don't need I don't have Australian dollars. So what can you do? You buy this bond, and then you do a cross-currency swap. Where you can swap the Australian dollar for US dollar, Australian to US. So the Australian dollar, now this is sometimes called an asset swap, and I will explain that maybe a little bit more if we have time today, or otherwise next time. Asset swap is a specialization in the swap market. So what you do is, so you have an Australian dollar bond, and then you add to that an Aussie dollar, US dollar cross-currency interest rate swap, CCIRS. You add the two together, it would be as if you have a US dollar bond. Cash flows. Together with, and this is the important point, Telstra credit risk. Now, that is exactly what you want, which you can't get in the market because they issued an Aussie dollar bond. Now, let me show you how that works. So on day one, you are the investor. Let's check what is the exchange rate today between Australian and US dollar. Okay, one Australian dollar is equal to 0.71 US, let's just say 70, okay, 70. So what you do, so 70 is a cool number. So if this is the bank, like SocGen. So I want to explain everything so you will be able to understand this transaction completely. So SocGen, they actually will, so remember this investor is a US dollar based investor. So they have some money today. So this is when they start. And so they're going to give to SocGen the US dollars, 70 million. I am assuming that the exchange rate is 70. I know it's not 70, but never mind. Let's just say it is 70. So it's a nice round number. And then SocGen will give them 100 million Aussie dollars. You do know that the Australian dollar exchange rate is quoted the other way around, don't you? The Aussie goes to the US dollar is at the back. So it's 1 Aussie for 7.7 US. There are 4 currencies which has this convention. Do you know which ones? This is one of them. Which are the other 3? Everything else is quoted with US dollar in front. I think this is called a indirect quote. This one is called a direct quote. The other ones are, no, yen is dollar yen. Huh? Very good. The pound. Anything else? Yen, no, yen is not. Yen is quoted dollar yen, not yen dollar. Okay, it's $1 for how many yen? So there are 4 currency quotations where the US dollar is not the base unit. So this is £1 for how many dollars? New Zealand, very good. And then euro. These are the only 4 I know of. Anyway, that's just a side comment. So after you do that, on day 1, so this investor can now go to the bond market and pay away this Australian dollar and actually get the Telstra bond. Correct? Yeah, so they own this bond now. Notice that operationally, what they actually have done is they paid away 70 million US dollars and they bought 100 million Australian dollar bond, which is exactly what they want. They don't have Australian dollars, they don't need it. Now, on coupon dates, and like I said, it doesn't really matter whether it is the investor doing the swap or whether you have an SPV doing the swap. The SPV is just standing in front of you like a letterbox, receiving all the cash flows, but in the end, the cash flows go to you. Okay, so the investor, or if you want to put the SPV there, okay, the investor from this bond, this Telstra bond. Now this Telstra bond is going to pay coupons in Australian dollars, and there is in Australian dollar actually an Aussie dollar LIBOR, but they are not using that index. There is another index called BBSW, Bank Bill Swap Rate. Just think of this as like the domestic version of LIBOR. It's like SHIBOR for Shanghai, for example. Okay. So anyway, this is just a floating rate in Australian dollars plus a spread. And I think in that deal, they tell you what the spread is, 160. So I'm going to put that there. 160 basis points is not bad. It's not bad for a telecom company. You get an extra 1.6%. And then what you do is you now this is part of the currency swap where you pay away this cash flows, BBSW plus 160, and Now, this is in Aussie dollar. It's worth pointing that out, in Aussie dollar. This one is also in Aussie dollar. But now they're going to pay you a US dollar cash flow, dollar LIBOR. Now, I said to you last time, near the end, might have been rushing it a little bit, that when you are swapping floating for floating, there are various names you can give to it. So you can call it a cross-currency interest rate swap. You can call it an asset swap. You can also call it a basis swap. It's all of these things. So it has different names. That happens very often in finance, that one transaction is characterized by a lot of different attributes. So when you are doing a basis swap, which is to say floating, or a cross-currency basis swap, when you pay one floating index, you should get another one that pays you LIBOR plus 160. Or BBSW, if you pay that, you should get LIBOR flat. Now, that's what I said, but I was being a bit economic with the truth, because that is not exactly what happens. Sometimes this number can change to either, I don't know, 170 or 155. Now, in the case of this transaction, if you read carefully, in fact, it swaps to 1.1. So BBSW plus 160 in Aussie dollar. First of all, I give you the theory. In theory, when you swap one floating index into another one, if you pay 160, you should get 160. That's the theory. In practice, you don't. There are reasons for that, which are supply and demand driven. And it also has to do with the shape of the yield curve as well. Okay, I don't want to go into the details of that, because that's more of a fixed income. That's more of a fixed income issue. But I don't want you just to go away and say, oh, it's different. Yeah, why is it different? I'm trying to tell you why. The difference can come from supply and demand dynamics, and also the different shape of the Australian and the US dollar yield curve. So here they are not the same. Okay, and if you go to Bloomberg and you look up, cross-currency swap, floating, or cross-currency basis swaps, you see all kinds of quotations versus dollar versus yen. It's always dollar versus something. Dollar versus Australian, dollar versus Hong Kong, dollar versus renminbi even. Okay, in the used to be the non-deliverable market. Is everyone okay so far? Yeah, you're okay with that? So now this is on coupon dates. So now what happens at maturity? Now I am at maturity. Now please keep in mind, I am assuming that nothing bad happens to Telstra. So there's no credit event of any kind at all. In that case, so the investor or the SPV, it doesn't matter. Please remember the investor is a US dollar investor. The investor is going to get back from Telstra, how much was that money? 100 million Australian dollars. The investor is going to pay back that money, and the investor will get back the 70 million US dollars. This cash flow, I'm going to change the color. This cash flow, and this one, and this cash flow, and this one here, and this cash flow, and this cash flow. These 6 different legs, 1, 2, 3, 4, 5, and 6. These, ladies and gentlemen, they form the foundation of this cross-currency swap, or cross-currency basis swap, if you want to be more specific, or cross-currency asset swap, if you want to be, if you want to call it in a different way. Is everyone okay with that? Yeah. You know, if ever you want to be a fixed income sales, no, not only that, if you want to be a fund manager, if you ever join a bond fund, you do this kind of stuff all the time, all the time. So please try to pay attention for your own benefit. Maybe you say, I don't want to be a fixed income sales. Well, you never know. And who knows, your next job, you could be working for a bond fund. Many people have, right? So is everyone okay with that? Now, if you're okay with that, I want to tell you what is the scenario if something goes wrong with Telstra. So imagine you do this, you bought this bond, this Telstra bond, for you pay $100 million, and maybe it's a 10-year trade, and then 3 years later, Telstra's gone bankrupt. Okay. You might say, no, that will never happen. Well, look, never say never. Okay, that's why there are black swans out there. Never is a long time. Anything can happen. You know, expect the unexpected. So let's say Telstra went bankrupt. Now, if you can, so as a finance professional, when you try to assess the damage, you pretty much can guarantee, just looking at these 2 diagrams, that anything that's got arrows going in and out basically are going to hurt, or are going to impact both the investor and also SocGen, because SocGen is connected to this investor via these arrows. Now, this one already happened. So number 1 already happened, because that, I said, is today. And then this trade might be a 10-year trade. So for the investor, there are 2 sources of impact. Source number 1 is the bond mark-to-market, the bond itself. Source number 2 is the cross-currency interest rate swap, mark-to-market. You understand what I'm saying? Because that's what they're doing. They've got one thing hanging around here, they've got another thing hanging around there. Now, as far as SocGen is concerned, so let's say this is X. Don't know what X is. For SocGen, how are they, if Telstra goes bankrupt, this transaction technically it can still go on because it is an entirely different trade, and SocGen doesn't really care. Well, they do care, but it is not really something that would touch them if Telstra goes bankrupt. But they will know about it, obviously, and they would know that this interest rate swap is related to that. But SocGen will have also the CCIRS mark-to-market, but they are on the other side. So they also will suffer exactly the same, but with a minus sign in front of it. Whatever X is, you turn that around, that is the impact on SocGen. Are you with me? Everyone is okay? Try to understand this, because if you do, you're going to find, the rest of this course a lot easier. So the CCIRS, in theory, can go on. It can go on. It can continue. But most likely, if you are the investor, you just want to get out of everything. Sell the bond. The bond might be worth, like 40 cents or whatever. So you're going to lose 60 cents. Now, when you are trying to assess the mark-to-market of the likely impact on the mark-to-market of a cross-currency swap. Now here I need to take a step back and kind of share with you some macroeconomic observations, okay? With a cross-currency swap, when you do a mark-to-market, so if you do a 10-year deal, so let's say your CCIRS is for 10 years, so starting from now until 2029, my God, that's a long time away. And then 3 years later, so in the year 2022, Telstra goes bankrupt. So there are 7 years to run. So what you need to do is you need to mark to market these cash flows for the next 7 years. And so every year there is 2 or 3% payments you pay to SG, and there's 2 or 3% payment coming to you. But the big one is the exchange at maturity, because this is when you have a huge exchange of principal. This is when you have a big amount exchanging. So when you look at the potential mark to market, people are always looking at what happens at the end, because that's where the weight will be. It's like when you are pricing a bond. You know how when you are, and some of you I know are doing fixed income. So you have these little cash flows, and then at maturity, there's a big one, right? And you know how when the yield goes up, the price goes down of a bond. You all know that, right? Now that is because when the yield goes up, the price of these little ones will go down. But what's most important is the price of this big one. You know that? That is my point. The point is, all right, when you are doing the mark to market on a swap, you do have to be concerned with these. You do, but mostly it is actually this one that is going to hurt. Or if you make money, it will be because of that. Is everyone okay with that? Now, one observation. So turn to a blank page. When you have a kind of, 10 years ago, or is it 11 now? 10 and a half years ago, when we had the last global financial crisis, and everything really, it felt like the end of the world. You pretty much, and history sometimes it does repeat itself, and whenever there is some kind of financial crisis, there are a number of things that practically happens every time. I'll tell you what they are. Number one, US Treasury yield. If there is some kind of pick your favorite crisis, whatever you want. Okay, China going to war with the United States, is that a crisis? Probably. Or think of something really. North Korea dropping a nuclear device somewhere. Think of something really wild. Okay. Donald Trump getting assassinated. Okay, I hope it doesn't happen, but something really wild. What typically happens to US Treasury yield? Yield goes down. Okay? In a crisis. And if you look at all the crises and all the stock market crashes that we have had in the last 100 years, I pretty much can bet you that every time this happened. Okay. The second thing is, what do you think happens to the US dollar? Have you thought about that? Yeah. Huh? Appreciates. Absolutely. Yeah. US dollar appreciates, or US dollar gets stronger versus the other currencies. Do you know why that? First of all, do you understand what I'm saying? If you look at the 2008 financial crisis, that certainly happened. You looked at the Asian financial crisis around the turn of the, no, that was 97, 98. In 98, when the Asian financial crisis, that certainly happened too. You look at the Gulf War, the war against Iraq. Okay, I think that also happened. So whenever there is a crisis, the US dollar normally appreciates, and the yen does as well. The yen is very strange. The yen appreciates and quite often the Swiss franc. But I'm not really concerned with these. These are just support acts. Now, euro is an interesting one. Euro, I am not sure what normally. Now, the reason the yen and the Swiss franc, the reason they appreciate, now you might think it's bullshit. It's your freedom. I'm just telling you the fact, okay? But the market's justification for it, sometimes I find it a bit hard to understand. They think the yen and the Swiss franc are what people call safe haven currencies. Safe haven means if there is a World War III or World War IV, okay, these are the places you want to go to because they are so safe and nice and calm and peaceful and civilized or whatever, okay? So they buy those currencies. Now yen, as you know well, the fiscal situation of that country is, absolutely disaster. But anyway, so I never completely understand why the yen is considered a safe haven currency. Now, the euro is I'm not sure. I'll tell you why I'm not sure. The reason I'm not sure whether the euro will appreciate in a time of crisis is the same reason that I am sure the US will appreciate. The US will appreciate because in a time of crisis, everyone needs dollars. For example, if I am trading in oil futures. Now, you know, oil is priced in dollars, like it or not. In fact, a lot of commodities are priced in dollars. If I trade the S&P, now I'm not even American. There are a lot of non-Americans trading dollar-denominated commodities and trading the S&P, trading dollar assets. In time of crisis, everybody will sell. Everybody needs to liquidate their positions because there are margin calls. So let's say I'm trading oil. I'm not American. I don't live in America. I don't got nothing to do with the United States, but I am trading a US dollar-based commodity. So if the oil price crashes, the broker gives me a margin call. Guess what? I need dollars. And you're going to find hundreds of millions of people out there all over the world in the same situation. That is why in a crisis, US dollar always appreciates. Are you with me? Now, that is also why I am not sure about the euro, because the euro doesn't have that privilege of being, you know, a widely used currency for pricing. We don't price oil in euro. We don't price commodities in euro. Yen, like I said, is sometimes regarded as a safe haven. So is the Swiss franc. Even though Switzerland is a very small country, they haven't been at war for the last 400 years. That's quite a that's a pretty good track record. But Switzerland, you know what is the population of Switzerland? You know, very small country. Well, like I said, never say never. No, but what was I asking you? Oh, what do you know the population of Switzerland? Switzerland. Make a guess. Huh? It's around 8 to 9. Yeah. So people think Switzerland is a big country. It isn't. You can be a country with just 9 million people. Well, there are even smaller countries than that. In fact, Singapore is a country, technically. What's the population of Singapore? 4 million. You didn't know that? What did you think it was, Tianwen? What? Much less? Oh, you thought Singapore had even less people? No. Singapore has half the people of Hong Kong. Singapore, the land size is about half of Hong Kong too. So the land size of I'm quite good with these numbers, you can see, right? The land size, that's it? Okay, I'll take 5. Okay, 5. 4 or 5. You know, it's interesting. I'll tell you an interesting fact. So Hong Kong, you know the geography of Hong Kong? So this is the Shenzhen River. So you got New Territory, you got Kowloon, you got the Hong Kong Island, and you got the Lantau, the Disneyland, right? That's Hong Kong. Singapore is approximately New Territory plus Kowloon. So the size of Singapore is like the size of Hong Kong minus the Lantau Island and minus the Hong Kong Island. Now here is the interesting thing. So the land area of Hong Kong is around 1,000 square kilometers, and it has 8 million people. Let's just say 8. And Singapore only has half of that. You see in a minute what I'm getting at. This is something that not many people know or think about. So you think, yeah, well, then Hong Kong has twice the people and twice the amount of land. Have you ever been to Singapore? Who's been to Singapore? It's actually quite a nice place. Okay, it's not as colorful or it's not as crazy as Hong Kong, but it's pleasant. The urban planning is quite good. And have you noticed there's actually more space in Singapore? More people live in houses in Singapore. Very good. You see the problem? The problem is, do you know what is the amount of usable land in Hong Kong? Any idea? Only 25% of the land is usable. So you've got 25% of the land shared by 8 million people, whereas Singapore is completely flat with half the people. What does that tell you? Hong Kong is 4 times the density of Singapore. Are you with me? Are you surprised that the properties here are so expensive? And sorry about that too. Okay, no, I'm sorry, I digress. Now, anyway, but this is a good digression. So I was talking about the what happens during a time of crisis is that the dollar always appreciates. Now, remember that fact. So, because I'm going to now bring you back to this interest rate swap, I'm going to bring you back and I'm going to talk about the mark-to-market, especially mark-to-market of this component. Now, at maturity, SG is going to receive Australian dollars and pay US. So technically, in traders' language, SG is long Aussie, short US. Are you with me? You are long Aussie because you got Aussie coming in. You are long Aussie dollars. Now, allow me to ask a simple question. If there is a global financial crisis, imagine World War III, and everyone getting hit by everyone else, and Telstra went bankrupt. As far as SG is concerned, are they going to lose money or make money from this component? Why are they going to lose money? Yeah, that's right. Yeah. In other words, they are long Aussie. Okay, you are long something, and that something is going down the toilet. Then you're going to lose money. So, in a time of crisis, they are going to lose massive amount of money, and you can talk about 10, maybe 20 million easily. If the FX fluctuates like 10%, that's a lot of money to lose for FX. Are you okay? So now I get to this trade here. Now, what is this trade? This trade is actually not so different from what I have described to you. There is just one additional feature. There is one additional feature. So 10 minutes ago, I described to you if Telstra goes bankrupt. If Telstra goes bankrupt, you got to use your imagination a little bit. It probably means the country itself is in some kind of trouble, and the Australian dollar will become very weak. So normally in this trade, if Telstra goes bankrupt and we have to do and then the client sells the bond and they want to do a mark-to-market on the swap, normally SocGen will lose money. Now, it is very, very unlikely that Telstra will ever go bankrupt. But like I said, never say never. So SocGen basically made a deal with this investor. SocGen is saying, look, if ever Telstra goes bankrupt, I know that we are supposed to mark to market on the coupons, and we're supposed to mark to market on the principal exchange at the end. How about we just forget about it? So we don't do the mark to market. You sell your bond at what price is your business, and we just tear up the swap contract. And there will be no more payments, and there is no mark to market payment you need to make to me. You don't pay me, I don't pay you. Zero. Are you with me? You understand? And the client will say, yeah, well, why should we do that? And SocGen's reply is, if you are happy to do that, I give you an extra 25 basis points. Now that, ladies and gentlemen, I think it's 25. Yeah. That is the so-called extinguisher swap. So instead of paying you LIBOR plus 110, I now pay you LIBOR plus 135. Are you with me? You must be wondering why. First of all, I like to think psychologically. Now, why would the client? It's worth analyzing this in more detail. Why would the client be happy to do that? The client is happy, I think, for two reasons. Reason one is they get an extra 25 basis points, number one. Reason number two, they consider the possibility of Telstra going bankrupt to be so unlikely, rightly or wrongly, that they are quite happy to take that risk. Yeah. Well, so you're asking me the client. First of all, I think the client thinks it's unlikely. Yes. As for, I think the client can. Okay, there are two ways you can look at this. The first way is you have a kind of subjective, professional opinion on the likelihood of something. The second way is you have some kind of pricing model which will tell you the possibility of some event. Now, it won't be zero. That's the key point. It is not zero. But it is very small. It's 0.005% or whatever. It is not zero. That's the key to it. You see, it's kind of hard to say, the client thinks it's less likely or SocGen thinks it's more likely. I think the client thinks it's not likely. Yes, in practice, to be honest with you. But as far as the bank on the other side with all the derivative technology, I think they just price a deal like that. They don't care whether it's likely or not likely. And the way they price it is they multiply the probability of Telstra going bankrupt, very, very small, and they multiply that with the potential, exactly, you guys are getting good at this, the potential mark-to-market loss from the cross-currency swap, and they think when you multiply the probability by the payoff, they think maybe, just maybe, this is worth like 30 basis points. Let's just say 30. and they decided to pay 25 to the client, for example. Now, you wonder, how did you come up with 30? Well, it depends. It could be that your loss is 30%, and you think that the chance of it happening is one in 1,000 or 1 in 10. I don't know how many zeros I need, and then you come up with 0.3%. So that is their calculation. Now, I just explained to you just now why would the client be motivated. They are motivated because they made a judgment. It could be both a qualitative judgment and a quantitative too. But I think the judgment has to, a subjective judgment has to be part of it. They think it is so unlikely for Telstra to go bankrupt that they want to just take the extra 25 basis points. And for SocGen, the benefit for them is if this really, really happens, now they will not have this massive mark-to-market loss anymore. So they've taken care of it on day one. So don't forget, banks also have a threshold of pain. How would you say that in Chinese? Right? And I think banks' threshold of pain, you might not know, actually is probably a lot lower than you imagine. It's a lot lower than some of the big hedge funds out there with large mark-to-market swings every day. So they also have a threshold of pain. They don't like to have losses, no matter how remote it might be. So now they have taken care of this, and what that means is, so you got to understand that when you are doing derivative transactions, you also have to set aside some capital. So you do 100 million, you do a $7 million trade, you may need to, so the regulators will ask you, okay, you need to have 3 million of capital. Let's just say 3 million. So a bank needs capital not only to finance their loans or buy bonds or make investments or lend money for mortgages. A bank also needs capital when they do derivative transactions. So the immediate question is why? Why does a bank need capital to do derivative transactions? It is because sometimes you can have big losses like this. So if you have now taken care of this, and you know that you will never run a big loss, you can go to the regulator and say, hey, do you mind if I just use 2 million capital instead of 3? And they might agree. That's the whole point. So you use less capital. Okay, that's the whole point of this. There's one more thing I want to say about this trade. Now, if you look carefully, a simple, what we call a vanilla cross-currency swap, when you buy the bond, so this swap, a normal cross-currency swap, has no relation to the credit risk. So regardless of what happens to the credit risk, the currency swap, at least in theory, can still continue forever. Now here, this is different. This currency swap, the nature will change when something happens to the credit of a company. That, ladies and gentlemen, is what's known as cross-asset structuring. Combining an interest rate derivative with a credit derivative. So the interest rate derivative, in other words, the cross-currency swap, has now got an embedded credit element in it. And the pricing and the behavior will depend on the evolution of that credit risk. Okay, this is the best way I can put it, the easiest way. And this is known as cross-asset structuring, and it would require you to model the behavior of a simple cross-currency swap, the correlation of that with the credit risk behavior of Telstra. Okay, you understand what I said just now, you understand a lot about what Ryan does, okay, because it's all about correlation. And this is what cross-asset structuring. So you now understand what cross-asset structuring is. It is pricing and modeling and packaging transactions where you are crossing different asset classes. It's actually it's far more complicated than just doing a simple trade. Okay? Everyone happy? Have you learned a lot today? Can you digest? Like I said, this will be recorded, and I'm going to put out a video. And do you have any questions? Because I have to run after this. I'm on a lunch appointment. If you yes. Yeah.
Because you mentioned that right-way risk is something you're going to take. So why do we want risk something else potentially? Well, I mean, this risk is to which part?
In fact, a good question, and I know it's not good to answer a question with a question, but a good way to challenge you is for this extinguisher transaction, think about whether SocGen actually has a right way risk or wrong way risk. But that's a different question. The idea of the right way risk or wrong way risk is purely to do with counterparty risk. Okay, you are faced with a counterparty, and I guess we kind of touched on that when we discussed ISDA last time. The concept of right way risk or wrong way risk is all to do with the correlation between the mark-to-market of a derivative trade, the correlation between that and the likely business prospects of that customer you are facing. It's a wrong way risk if they go in the same direction. In other words, it's a wrong way risk if your client is likely to go down the toilet when the trade is going down the toilet. That's it. The right way risk is when they kind of hedge each other. Right way risk would be if your client is doing well, the trade might be doing badly. Or if the client is doing badly, the trade might be doing well. Now, the trade doing well, please remember that is from the client's point of view. So client doing badly, trade doing well from client's point of view, but trade is doing badly from your point of view. But guess what? Maybe you have turned around and hedged with JP Morgan. So from the market risk perspective, you don't have a risk, but now you have two counterparty risks. Okay? So you've got to be clear just what, I guess if I say instead of wrong way risk, if I just put wrong way counterparty risk or right way counterparty risk, that is easier to understand. But no one calls it that, although that's what they are thinking of, or that's what they're referring to. Okay? Have I answered your question? Yeah. Yeah, go home and think about whether SocGen has a right way risk or wrong way risk here. We can talk about that next time. All right. Just a quick reminder So tonight you are with Ryan, and unfortunately tonight I can't be there. And next time we meet is on the 27th of April. Just follow this calendar. And the next time you see Ryan after tonight is the 26th of April. So I wish you a very happy Easter. And if you are going away, travel safe and have fun. Okay? I'm going to save this and I'm going to produce the videos and I'm going to put them online. Thank you everyone for coming. Okay?